Okay, let's hit record again. Okay, welcome to week 6, 7, how the weeks are going by us. Let me share my screen in terms of where we are here. And I will scoot this guy back up. And I will hit this. Well, that didn't work out. There you go. So welcome to week 7. It's going to be equity investing using stock. As before, when we go through, we're going to leave off, keep you unmuted, or muted rather, and no video because we're not allowed to have your picture anywhere in the presentations. Again, up in the upper, on a PC, in the upper right, you can change to full screen or different views in terms of what are there if it makes it easier for you. So you can click through those. Also, as before, if you want to send us a comment, since we've muted you, you can click on chat. Box is going to pop up. You type in what you want to say. When you hit enter, that comes to me, and I get to read them and decide which ones we are looking at and when we're looking at them. So that's what we go through and do. Generally, I mean, we've answered all of them as we've gone along, so that's not anything. On itsyourmoneyandestate.org, the group's website, you can go to workshops, It's Your Money, click down to what week you want, and the video of this and the handout material will be in here. I can't tell you if it'll be the beginning or the end of it, but you will be able to see the videos that we have done as well as the handout material also. So that's also an availability to you. We have gone through, we're through 6 weeks. This is 7th week, which is stocks. Next week, we're going to talk about your mind and your money. And Pete's going to do a summary of what all's gone on in the last few weeks. So go for it, Pete.
Okay. Welcome, everyone. And thanks for sticking with us. So this is a real experience for us all. Week 1 was essentially a quiz to hopefully that kind of shows you that what you didn't know, what you did know. And the second week was about that the financial services industry is a sales organization, from hedge funds to annuities to free dinners to contests to commissions on sales. It's a sales world, and most of the individuals in this world revolves around selling product. We don't think that selling a product is what financial advice or a financial service professional should be about. That's why we went through Financial Planning 1. What is your goals? What are your assets? What's your net worth? What's your risk tolerance? Once you know all of that, then you can begin talking about how you want to invest your money. And when we talked about investing your money, we talked about asset allocation and the importance of diversification. We get the question a lot is, what is a safe investment? And, in the common sense word of safe investment, I don't know if that's answerable, but diversification is your best answer to safety. We went through the medical care planning. Just like the virus and everything that's going on today, the medical industry is completely changing. We're in a major transition. Caregiving costs have increased, insurance costs have increased, and you need to have someone to be your advocate for medical care. And it could be one of your most expensive items during your lifetime. Fixed income investing we had last week, and how to use bonds. And we did get some feedback a little bit that it might have been gone a little bit too quick. So I'm going to ask Laura just to kind of focus in on what asset allocation is all about between fixed income and stocks and why that is important. So today what we're going to do is the stock market and equity investing. And let's introduce Laura through our Ask First forum. Oops.
Go for it, Laura. You got control.
Okay. Whoa.
All I see is a big
Hang on.
zoom on my screen.
That's because you're talking, Pete.
Okay.
All right.
Clicks up. There you go.
Okay.
We practiced this for a half hour. I'm glad I got it right.
Oh no! Don't admit to that.
Okay. Hey, Laura, you got a bachelor's degree from UCLA. You put down on your that you have a credential of a CFP.
Wait, you're not going to beat me up for my major like you usually
No,
do?
I already know you're an English major. Talk a little bit about, because I think beyond the CFP credential, your years of relevant experience. And I think that's much more important. So talk a little bit about yourself, your background. I believe you have told me that you have been one time on the dark side. And what does that mean?
Yes, so I started out in the business in the early 1980s and on the dark side, which is the sales side of the industry, which Pete's talked about, I know a little in some of the prior sessions, but worked for a small independent brokerage firm, and I mean, literally was knocking on doors trying to make sales to have people buy stocks and bonds and mutual funds. And that was kind of the original way that the business worked, and there wasn't an option early on. And you got commissions for putting people in particular investments, and some investments paid more commissions than others. And it just never really felt right to me. And I was at a Financial Planning Association meeting, and someone was talking about kind of the new way of doing business is you don't sell, but you're charging clients a fee for service that you provide and advice that you provide. So that was kind of how the industry started evolving by the 80s and 90s. And I remember making that kind of switch over from the dark side, very different feeling when you're really 100% on the client side, thinking that, of course, the whole industry was going to be there, you know, in 5 or 10 years. And that didn't happen. So yeah.
Today, for example, you have a fee-only fiduciary registered investment practice, correct?
Yes, and it's super, super complicated and difficult for even those in the industry to figure out who's who, and are you really fee only? Are you selling stuff, you know, and it's kind of hidden. As a matter of fact, the Orange County Business Journal just came out with their list, and they haven't quite figured it out yet, because people who are selling tend to try to hide that and make it look like they're not. And, you know, even though there's, you know, regulation upon regulation, you know, designed to have us have to disclose stuff, you know, the brokerage firms find a way around it. And the bulk of the investable assets in the country are still with the big banks and brokerage firms. And, you know, with them, you just see they're opening fake accounts. They're having huge lawsuit settlements from bad investments and clients that are unhappy, you know. And to be in business as a small independent, you know, relatively small, I mean, we're you know, good size for a small firm, but you can't have any of those things on your record. If we had any of those things on our record, you know, we wouldn't be able to get clients. And yet, you know, if you look at the disclosures on, you know, the big brokerage firms, there's, you know, thousands of pages of all the lawsuits against them. So it's just a very different way of doing business, being completely independent and not beholden to public shareholders.
So just to briefly, because I know you have had clients who've had as low as $200,000 in investable assets, and you've had clients who have as high as over $1 billion in assets. Is the process that you use the same with the smaller client as you do with the bigger client?
Yes, it's generally the same. And, you know, we will go through what we call sustainable spending analysis for somebody who has 50, 100 million to see what they could afford to spend every year during their life. I mean, some people have that much money and they're at risk of running out. On the other side, they may benefit from knowing that what they're spending is going to have their assets last forever, and maybe they could be doing something better than just accumulating more hundreds of millions of assets, and they could consider some philanthropy and giving some of it away. But it's the same. Sometimes we're solving for different things, but it's the same process.
The planning process is very similar.
Yep, reviewing the insurance, looking at the taxes, any retirement assets, making sure the estate planning is in place. Exactly the same process.
Okay. I've noticed that you don't have any relevant licenses, and why is that?
Because we don't sell anything.
Okay.
So, whereas people who have a lot of licenses will put that on there like that's a good thing. I think from the consumer's point of view, that should be a red flag or just a caution, cautionary thing. Like if they have those licenses, if they have an insurance license and that is it, insurance is likely to be the answer to any problem you pose to that person.
And even in the industry, just for those who are listening in right now, for those in the industry, they get confused. Like the Series 65 is a registration, but it's the registration is through FINRA, and some people get that confused to be a license, which it really isn't.
It's not really. It's not a sales license.
Yeah.
It's super confusing, and that's where people should ask a lot of questions, direct questions, and don't feel stupid about it because it's very complex, and the industry tries to make it complex.
And they try to make you feel stupid so you don't ask any additional questions.
Yep.
So, okay. You're a fiduciary. We went through that. You put your client's interest first before your own. You charge only fees. Every professional operates a little bit differently. Talk a little bit how you do it and what's your minimum and hourly rate or minimum assets under management.
Sure, and we've done it different ways over the years, but at present we aren't doing hourly planning. We're only doing planning for people who qualify as clients, and generally that's a $5 million investable asset level for our firm. And we will charge either a percentage of the assets that we're managing, and more frequently we're charging a fee based on the overall balance sheet because we're involved in helping them with business issues and real estate and other holdings. So we're charging based on the balance sheet.
And then so under assets under management, what is your initial percentage fee?
Generally 0.75%, 75 basis points.
75 basis points. And the client pays you, no one else.
Yep.
Okay. So, and who do you use as a custodian?
Schwab Trade. So the merger just they announced, the Department of Justice approved the merger of Schwab and TD Ameritrade yesterday. We work with both of them, so that's fine. And I could comment on that. Nobody in the industry, I don't think on our side sees this as a good thing. It's less competition and so on. But
I agree.
Is what it is.
So you're not connected with anyone who sells insurance, annuities, etc. Nope. And you, under penalty of perjury, you sign below, and that's your ask first form. This is the minimum someone should know about you. I think there's so many more wonderful things I could say about you regarding your charitable work. You're in the community here in Laguna Beach. Started and made the Laguna Beach Community Foundation work. You encourage philanthropy for all your clients. If someone is looking for a financial advisor, someone like yourself, can you make referrals if they don't meet your qualifications?
Yes, we do that often. We actually, we kind of have an internal list of people, and we know everybody in the community. I was the director of the CFP program at UC Irvine for 20 years. And, I think I know most of the CFPs in the community, and different ones are a better fit for different situations. I'm happy to talk to anybody about that. I really encourage people to call and ask, because sometimes, they're talking to someone who's saying they're a fee only planner like we're recommending, and I know that they're really not, that they're selling non-traded REITs and stuff like that. So I am happy to help get people to the right place, or give them a couple good suggestions. As Pete obviously knows everybody too.
Okay, why don't we get started on your outline and presentation?
let's see if I get this right.
Hey,
All right, good. And so, and Don, you'll let me know if we're going to ask questions in the middle of it, right? I mean, it's fine with me to
This
jump in.
is the voice of God.
Yes, I will let you know. There are no questions so far.
Okay, good.
and,
All right.
and Laura, just because we're on Zoom, that does not mean I'm not going to interrupt you.
Okay. Oh, okay.
Trust me.
Okay. Wouldn't be fun if you didn't. So, okay, yeah. So these are some of the things we're going to cover: the basics of the stock market, types of investments, how you select investments, active versus passive. What does that mean? Costs, sources of information, and then, as Pete said, we will spend a bit of time on asset allocation, why that's important, what it means, and how you might want to look at that. How do you assess performance, and then should you seek professional management or try to do it yourself? So this is the equity investing section. We actually kind of have a policy here at the firm that we try to not use that term, and we say stocks. Fixed income is bonds generally. Equities are stocks, all for the most part. And so an equity is simply a stock. And a stock represents a share of ownership in a company. It could be a public company or a private company. And public companies' shares are traded on stock exchanges, which match buyers and sellers. And that, to me, it's always kind of interesting just to even remember that. When you see a price go way up or a price go way down on an individual security, there's always someone on the other side of that trade. Someone's paying that price to buy it, someone's selling it that price. They're matching that up, and that's what the stock exchanges do.
So somebody actually believes that the price is going to go higher, and somebody actually believes that the price is going to go lower.
Yes.
Yeah.
Yes. And I would argue, of course nobody knows. It seems obvious to me that nobody really knows, but we'll get into that. So stock certificates used to be, you'd always get a stock certificate when you owned a stock. I'm sure many or most of you have had stock certificates or have seen them. They're still out there. Companies do not issue stock certificates anymore.
Oh, really?
Yeah, and it actually can be, I think sometimes people will charge you to deposit your certificate to get it into a brokerage account. They're difficult to deal with, of course, because you can't sell them right away unless they're deposited in a brokerage firm. I would recommend anybody who has certificates, you're much safer and you're much more liquid if you could get those held in a brokerage account. And there are some firms that won't charge you. I don't think Schwab or TD Ameritrade charges you for depositing and holding the certificates. But also, as far as your family and your estate planning, it's like the worst thing an executor can find, having been one, I can say, is a bunch of stock certificates. You have to go to each transfer agent. You've just extended the process by months. We end up doing a lot of that here. So I'd recommend, they're kind of cool looking. They're on really neat paper, like a currency or something, but get them deposited in a brokerage account.
The only one I would take exception to might be the Disneyland.
Yes, frame that one and put it on the wall.
Exactly.
And we've had to go to some pretty great lengths to get some of those certificates. I don't even know if you can anymore for clients who wanted to give a couple shares to the kid or whatever. But I think it'd be costly to get the certificates. Yeah, you have to pay for them. So market cap, what does that mean? You hear that term a lot. The market cap of a company is just its value. It's the number of shares that the company's issued times the current market price. So the company's value fluctuates every day with the stock market, and can change dramatically. So you kind of hear about the big, who's the biggest company, Apple, Amazon, what's going on in the marketplace. But that's what market cap means. So stocks are generally broken down into three kind of main categories size-wise. There's also a micro cap and some other definitions, but generally it's large, mid, and small cap. And small cap is a company that's worth less than $5. Generally, these are not hard and fast definitions. Different people define them differently, but I think Morningstar, which is one of the big data agencies, and most companies define them pretty much this way. So overall value of $5 billion. Mid cap is 5 to 10, and large cap is more than 10 billion. And of course, companies can move among these tiers as they rise and fall in value also. When we talk about asset allocation and getting a diversified portfolio, it makes sense to have stock holdings in all of these categories. We think some firms just do small and large cap, but we'll look at we'll look at mid cap and how that's compared to some of the small and large, and I think there's a pretty good argument to having a dedicated mid cap allocation. But anyway, those are the three kind of general categories there. So stocks have ticker symbols. If you're watching the ticker tape go across the screen on the TV, you see those, and companies with 3 letters are traded generally on the New York Stock Exchange, and with 4 letters on the NASDAQ. Generally, mutual funds have, by the way, 5 letters in their ticker symbol. So investing in stocks, is it just gambling? I would say investing in individual stocks kind of is gambling, but investing in the stock market in general, if you do it right and you have a well allocated, well diversified portfolio, is not gambling. I think it's other than owning a business yourself, starting and owning a business, probably the best way to generate wealth long term is in the stock market, and more so than real estate generally, and we'll just talk a little bit about that. But you have to do it the right way and not try to get too tricky with it. So the stock market's bars on the right side here show that since 1926, so really before the Great Depression, and so including that time and every big downturn we've had since then, in any 1 year period, it's been 73% of the time that stocks have gone up in value. Over a 5-year period, 87% of those 5-year periods since 1926, stocks have gone up in value. And for every 15-year holding period since 1926, you haven't lost money investing in stocks. So when we talk long-term, 15 years is definitely long-term. So better than gambling. So I've been saying a lot the last few years, as we, before this current crisis, lots of people are saying the market's so high and what's going to happen and shouldn't we get out? And, we get that all the time at different market phases. And we could talk about how risky it is to try to figure that out. Current time, case in point, I didn't actually see the final numbers. I know the market closed up today, but we're probably even for the year pretty much, which is insane. Who would have thought? But over the last 90 years, the U.S. stock markets have returned 10 to 12% annualized return, which that sounds, I still find that kind of shocking. Having been in the business about 40 years, it doesn't feel like that, but it's actually what's happened. And the key is to capture the returns of the markets as cheaply and tax efficiently as possible. If you're paying a lot in commissions and fees and trading costs, that eats up a lot of your return. If you're paying, a third of it in taxes, that's going to eat into your return. So those two things are very important. So there's obviously better ways to do that, and not so good ways to do that. So this is a pretty famous chart, the Ibbotson chart. Many of you have probably seen this, but this is updated through 2019, and it shows the average annual compounded return of, first of all, inflation. It starts if you invested $1 in 1926, what did that dollar grow to by the end of last year? So $1, inflation-wise, at $14, that's like saying what $1 bought in 26, it takes $14 to buy that same thing today. If you invested in treasury bills, which is by definition the definition of a risk-free investment, because the government can always print more money and they're going to pay that back. Treasury bills are kind of known as the risk-free investment. Different kinds of risks. You have inflation risk and different risks, but treasury bills, 3.3% over time. And then government bonds, which is longer term, the 20-year government bond is the measure there, a little higher return. But then large stocks, which would be the large companies, will go into that. The S&P 500 is kind of the measure, the index for that, growing to $9,000 or a 10% annualized return. And then small stocks, way more than that. $1 grows to $39,380. And so, the other thing I think that's interesting about this is like small cap stocks about 12%, large cap about 10%. That 2% difference over that long time period, look at the difference in the dollars that you end up with, the 9,000 versus the 39,000. You certainly wouldn't want to put all your money in large or small cap stocks, or even in stocks in general. Most people wouldn't. I do, but anyway, just saying, because I'm very confident that long-term that's the right way to be. But you should not do that. Probably you want to have your portfolio well allocated with some bonds and fixed income in there also, which we'll get to. But this is, you see the downturns, and who knows where we're going to end up when we get through the end of this. Right now, it's not even a blip. Wouldn't even be a blip on this chart, but obviously we're not through this yet. So the way that you can access investments in the stock market is to say individual stocks. People get very attached to some of the individual stocks, and if you have an interest in that, if you do that the right way, that can work. More common for individual investors is mutual funds, where you're buying a basket of stocks. So you're paying a professional manager to pick those stocks for you, and you buy shares of a mutual fund. And then the third way is exchange traded funds, which came about in the very late 90s, the ETFs, exchange traded funds. And that's a basket of stocks, but it's not a mutual fund. It trades like a stock. And why that's different is, if you buy a stock during the day in the stock market, it's trading at different prices all day. So, if it's a wild trading day, which it usually is, you could buy a stock at $10 a share or $14 a share, depending on what point in the day you bought it. If you're buying mutual funds, the basket of stocks that are inside that mutual fund are only priced once a day at the end of the market. So when you're putting a trade in for a mutual fund, it doesn't matter what time of day you buy it, you're going to get that end of day price, which is, calculated based on all the holdings within the fund. Exchange traded funds is a basket of stocks, could be the same basket held in some mutual fund, but it trades intraday. So you can buy and sell during the day, which is a good thing for fast traders and day traders, not necessarily a good thing in itself for individual investors. We're not encouraging people to do active trading, but there are some other good things about the way that exchange traded funds are structured, which is they're very cheap, because at least the original ones, they're not all like this now. You were buying kind of a fixed basket, usually an index of stocks, and it's not actively managed. So with the mutual fund, you have to pay a management fee inside the fund. It's not paid by you directly, but within the fund, you're paying an ongoing management fee to somebody who's picking the stocks in the fund. With an exchange traded fund, if you're buying the S&P 500 index, and we'll get into what all that is, you're not paying a manager. You're just saying, we're buying the S&P 500, whatever is in that this week, we're going to buy that, and you don't pay a management fee. So the costs are much lower on the exchange traded funds, and that's why we like them, because they're lower costs, and that matters over time, which we'll talk about. So if you are going to buy individual stocks, just to talk about this very briefly, kind of two main schools of thought of how you pick which stocks you buy and when you buy stocks: fundamental analysis and technical analysis. Fundamental analysis is where you're actually analyzing the individual companies. You're looking at their balance sheets. You're looking at their management. Where do they fit in the industry? What are their growth prospects? Lots of different ratios, the price earnings ratio and PEG ratio, what kind of growth prospects. That's what fundamental analysis is, and probably what most managers follow. And then there's also technical analysis, which is, your charts and graphs and charting trends and trying to figure out what the market's going to do based on different patterns. And there's just a crazy amount of ways that people do this. This is kind of where market timing falls, where, based on what the market's doing, you're going to try to guess what happens. And most professionals think that doesn't make a lot of sense, and certainly the results have borne that out. But once in a while, somebody gets it right, and so that becomes a thing that people follow for a while.
Laura?
Yep.
Yes. Slide back, one more slide. There was a question of NSA.
Of what?
NSA. Terry, what do you mean by that? All it says is NSA. I didn't know if you go forward a slide, if there's another individual mutual fund, exchange traded, all it says is NSA.
As a type of?
I don't know. All it says is NSA, and Terry hasn't told me more. Oh, there you go. Net asset value.
Okay, NAV, net asset value. We're going to get to that.
Thank you.
Yeah, that relates to the mutual fund, and we're going to get to that. Yeah, because I said the NAV probably. Yeah, and what does that mean? It's the actual price of the mutual fund at the end of the day. Yeah, so just since we're on it, so mutual funds, if they, depending on how they're structured, may have a load or commission up front, for example, and you may, buy a mutual fund that's priced at $10 a share, but there's a 10% commission, which actually that doesn't exist anymore, but it used to exist. And if that was the case, it'd be $11 for you to buy in because you're paying that commission. So $10 would be the net asset value, net after the fee, and $11 would be the offering price. So NAV is actually the price that you're buying the mutual fund at. And they've figured out ways to hide all those commissions. So there's lots of ways that they're built in there, which we'll talk about.
Yeah. And remember, on mutual funds, the small cap, mid cap, large cap means the objective of that particular fund. And we're going to go through these types right now.
Yep. Yeah, so there's lots of different ways that you could split out types of mutual funds. One is by style, investing style. So all stocks can be divided into either growth or value stocks, and that is based on certain metrics about the company, the size, the book value, the profitability, and growth stocks are generally stocks that are growing faster, maybe faster than the average market, tend to reinvest their growth into the company and not pay dividends. Amazon, Apple, the tech stocks are, I think, all growth stocks in that category. Whereas value stocks are, considered undervalued companies, usually often trading below book value, below what the company is, technically worth. And, it's the way that Warren Buffett has always invested, where you're buying unloved companies that have perhaps a lot of future growth potential. And value and growth strategies run in cycles. Then, of course, the cycles aren't most people believe the cycles aren't predictable. I'm sure some people think the cycles are predictable. We've been in a market for quite a while where growth has been way ahead of value for 7-8 years. And a lot of value investors have hung in there as value investors, saying it's going to turn around and that's going to change. And then there's a lot of arguments why maybe that's not going to change. Over time, over a really long period of time, value stocks have outperformed growth. And so that's why a lot of people are kind of holding on to that. And it's been a really significant difference in performance of like a value mutual fund versus a growth mutual fund. And, depending on the fund, it can be pretty extreme. So we don't try to bet on value versus growth. A lot of firms are growth-focused investors, and some are value-focused. We don't try to guess which ones are going to outperform. So we make sure that we're diversified. The S&P 500, kind of by definition, is half growth stocks and half value stocks. So just by buying that, the most representational followed index in the market, you're going to be getting a mix of value and growth stocks. But the S&P 500 is large cap, all large cap. If you're just investing that way, and a lot of the brokerage firms don't venture into small cap or mid cap very often, sometimes they don't really take that approach of balancing the portfolio, have been largely in the large cap arena. That's worked out pretty well the last few years, especially as the 5 big tech companies have just been on a tear. So that's played out well in the short term. That doesn't always play out in the long term. We really believe in diversifying that. So you can buy mutual funds that are growth funds, value funds, or blends, like an S&P 500 type mutual fund. You can buy small, mid, and large, like we talked about, so market cap. And then you can buy U.S. international funds, or global, which global has U.S. and international in them. And then you could also buy funds that specialize on a sector. You could buy funds that just invest in banks and financial services companies, or funds that just invest in the healthcare industry, that type of thing. So you can make sector bets. A lot of firms make sector bets.
The important thing for our attendees is, I believe, that they look at their own mutual funds and identify them and find out what percentage do they have in growth, What percentage do they have in value? What percentage do they have in small cap? What percentage do they have in mid cap? Most individuals, I don't think, have a clue as to the percentage of their total portfolio is in international.
Right. If you have 8 mutual funds, there's maybe a lot of overlap, or you might actually be getting true diversification. We'll talk about some tools, but Morningstar has tools available. I think some of them for free for individual investors to try to assess your portfolio by looking at all the different funds. And, but certainly advisors can help you with that. You might even be able to find that out in a free introductory meeting with an advisor, how your portfolio lays out and what do you really have. Cost to buy the funds, there's all different sorts of share classes, A, B, C, etc. It's really difficult to figure out what's what, but there are costs up front sometimes. There's sometimes costs on the back end when you sell, and sometimes there's costs all along the way.
We've gone through the ABC shares, and we basically stated stick with no load funds.
Yeah, though it's hard to say, sometimes they say they're no load. And, I remember a broker saying, well, you're not paying it, the fund companies, you're not paying me the commission, the fund company's paying me the commission. Well, yeah, but it's coming out of the money that I gave the fund company. So they have ways to trick you.
They do.
So net asset value, we talked about that on mutual funds. That's the end of day pricing of the funds. And that's one way that you could tell if you have a front end load fund. Used to be in the newspaper. I don't really look at things that way if it's still in the newspaper. If the net asset value and the offering price are the same, then it's a no front end load fund, but you still could be paying along the way. And if there's a difference, then it's a front end load if the offering price is higher than the net asset value.
There's no reason to buy a loaded fund today.
No, and the argument is that you're getting the advice of maybe the advice of a broker, but not the advice is usually limited to what they can sell you.
Yeah.
And yeah, as I say, sadly, all CFPs, there's CFPs who are brokers too. I'm a super strong believer in the CFP.
There's CPAs who are brokers. There's MDs that are brokers.
Yeah.
There are attorneys that are brokers.
Right.
So be careful.
Yep. So Morningstar, again, kind of the premier rating service. It's cool because Morningstar was just, I think I started a little bit before Morningstar started in the business, and I had a board meeting recently in Chicago at their headquarters, which is like insanely impressive and really cool. They've become like the powerhouse data center and analytical tool provider, both to retail investors and professional investors. We use a lot of their tools as well. So I would suggest that's a good way to start. They have, ratings services and different ways to help figure out which funds to buy.
My only comment on that is don't just go with the star system.
Mm-hmm.
That might be a good start, but just don't depend on the star system.
Right. And I know they've changed how they do that, but there's, a lot of backward looking in part of how that's figured out. And yeah, it's a lot to consider there. And part of that is, so assets under management is something we think certainly individuals should look at. I would say you really probably shouldn't consider a fund that has less than 500 million in assets. We were just talking here, we recently, I think we're looking at a fund that has 300 million because we know the manager and the team who came from somewhere else. But generally, 500 million would be kind of the minimum. Most funds that you look at will have quite a bit more than that. The manager tenure, how long has the manager been at that fund? Because in most mutual funds, if you're not buying an index fund, which we'll talk about in a minute, you're buying the manager's expertise. So how long have they been there? And is the track record on that fund with that manager? Or did that manager just come in and start last year and that wasn't even his track record? And that's the other time sometimes if we would follow a manager, even if he has a short track record, because we know his track record from where he was before. So that, and funds play some games there. They bury bad performance by switching managers and changing fund names and that kind of thing sometimes. So, but Morningstar is pretty good about calling that out. Expense ratio on the fund is very important. I think I have a slide here a little farther along that says it's under 1%, the average expense ratio on the fund, but it can go as high as 2 or 3%. And that's kind of an underlying fee in addition to any fees or loads that you paid to buy the fund or that you may pay to get out of the fund. So there's ongoing expense ratio fees that include, things like the manager fees and underlying trading costs and so on. So that's important to look at. Now we'll get into that a little bit more in a bit. Then of course, historical performance is important. How do they perform in different market cycles? Tax efficiency, very important. And that's one of the potential downsides of a mutual fund is mutual funds, as we say, it's that basket of stocks that, the manager is buying and selling throughout the year. And then at the end of the year, the capital gains taxes that are owed on the trades that happen during the year are basically shared with all of the shareholders. So what the funds do is they will spit out capital gains. It could be several times a year, often once a year, usually in the fall, October, November. You'll get a capital gains distribution, which you think that's a good thing. It's not a good thing. It's a bad thing because it doesn't mean you have any more money. It just means you have a tax liability. And the way that works is that, if your share is trading, your fund shares are trading at $10 and they gave a 10% capital gains distribution, the next day your shares are worth $9, but you got a 10% back in a tax liability. So they made you cash in part of your fund that, you may or may not want to do that. And it often comes as a surprise. Sometimes the managers will give you some heads up on that. Sometimes you can call the fund. There are research places where you can go to see anticipated distributions, but it could be bad. They've had distributions, in the 30% range where you're getting like 30% of your fund back in a taxable distribution, and you can't not take it. So sometimes, if you're investing in an IRA, you don't have to worry about that. So that if you're buying individual stocks and funds, maybe funds in your IRA might make sense. So some funds are more tax efficient than others, and depending on how they do their trading and what they do, they're more tax efficient. And then of course, back to the exchange traded funds, very tax efficient, which we'll talk about again a bit more. So load, no load, and what share class. And so if you're working with an advisor, there are different share classes that we can access that retail investors can't. And I don't even know all the names of the different share classes. And actually, we're under SEC audit right now. One of the things that the SEC is looking at is like, are you getting the best, share class for your clients? Which, if you're on the brokerage side, you don't have to get the best share class for your clients. But on the registered investment side, where we're being audited, that we have to show that we're buying, the best one for the clients. And of course we are, because, we don't get any more depending on the share class. So we have to look at that. And with different funds and different types of things, sometimes it's a different kind of share class. So it's something we have to pay.
By the way, on your statement, when you receive your statement, it'll tell you what share class you have. So A, B, C, D, E, F, G, H, I, J, K, it goes throughout the entire alphabet. The most popular is the A, B, and C, but you can't really tell what that share class means until you look it up in the prospectus. The best issue, though, stick with a no-load fund, and there's over 18,000 mutual funds, and they open and close every day because mutual funds want to have a good track record. So if it has a bad track record, they'll close that fund, move it over to another. Lots of game playing, yep. And most people purchase load funds. So right. Stick with no load, right. Or ETFs. What is an ETF?
So the exchange traded fund it's like a mutual fund, but it's priced ongoing during the day instead of at the end of the day. And the original exchange traded funds were formed as index funds, and I think we go into this, but now there are exchange traded funds that are all types, and there are now bad exchange traded funds, and now there are expensive exchange traded funds, and there are tax inefficient exchange traded funds, which didn't used to be the case. So we love the original tax efficient index funds, very low cost, but just because it's an ETF doesn't mean it's good. Yeah. you are usually replicating an index or a particular sector. I mean, it's similar to mutual funds. So just to the index discussion a little bit, you can buy, as I said, you could buy the S&P 500 index instead of buying a mutual fund with a manager who's going to try to pick the best stocks, since that we'll show you how successful that works out to be over time. You may just want to buy the index, and so you have a choice of buying a mutual fund that buys the S&P 500, or buying an ETF that buys it. And usually they're both very cheap. Sometimes one you could buy it cheaper for less of a ticket charge than on another one. So either one can make sense, but we would usually try to do ETFs where we can, because they're very low cost. So we'll get into this again, but the average mutual fund share cost or annual expense cost is a little under 1% a year, and the exchange traded funds go as little as, I think, 0.03 percent to on an ongoing annual management fee. So extremely different cost structure there, because you're not paying a manager to trade it. It's super low cost. And many of the exchange traded funds have never made a capital gains distribution. So way more tax efficient. Now our clients are all very tax focused, tax aware, so we're very careful about that. However, I will point out enhanced ETFs can be very dangerous. Some of those use leverage. A lot of people got in trouble with a lot of those leveraged ETFs that are, they have wild swings up or down. Everybody was sure the market was going to keep going down a couple months ago, and a lot of people got into some of those leveraged funds and just, got wiped out. So would avoid any funds with leverage or any of those crazy enhancements.
For clients who want to do it themselves, I usually recommend going to Vanguard and using their index funds.
Yep.
And it's safe, it's cheap, and you can't trade them during the day, which I think is a good thing, for the average consumer.
Yep, I agree, and I'll actually reference a couple of their funds. I think that's a great way to go. Again, and Vanguard was really the company was John Bogle was the inventor of the index fund in the first place. You're not doing stock picking. You're buying you're buying the large cap index, you're buying the small cap, you're buying the mid cap, you're buying the international. No stock picking, very efficient tax wise and low cost. There's many indices that you could pick. I mean, there's all kinds of financial services index and the cannabis index. I mean, there's all kinds of crazy things you could do. And I'd say don't get too tricky or think that you're sure that this sector is going to go up because of what's happening in the market.
Laura?
I don't know. Maybe some of you know, but I don't know.
Laura?
Yes.
There's a question of how would I know if a particular ETF was enhanced? Is it in their name?
Yeah. Well, it probably has a very flashy name. That's a good question. Again, reading through the prospectus and the materials, I mean, I don't know that you can pick it out from the name. But it's something
I assume not. But
yeah, it's like if it's using, it's going to go up 3 times if the market goes up, that would be enhanced.
Yeah, and you can't even pick out a mutual fund by their name.
Right.
So you've got to at least understand the objective of that fund.
Another question is what's iShares?
So iShares was actually the original creator of the exchange traded funds. It's an
ETF.
Yeah, there's branding.
Okay.
BlackRock. You say Barclays. BlackRock. BlackRock is iShares is their ETF, one of their ETF brands. So those are brands.
And Spider is the S&P 500.
Right. So investing in indexes is also sometimes referred to as passive investing. I think that term has gone out of favor. I think we invest largely that way, and we don't use that term so much. It's also there's a big passive investing indexing firm that has used the term evidence-based investing, and that's what they call investing in indices. And what this chart shows you is in the different categories of small, mid, and large and international funds, actively managed funds, what percent of those that have a manager trying to pick the right stocks, what percentage of those outperform just the index, like the S&P 500, if it was a large company blend manager versus the S&P 500, which is the large company blend index, how many of those managers outperform that index? And you need them to outperform because you're paying them an extra management fee. So this chart does not even take into account management fees or taxes, but how much they underperformed the index. So, generally 70, 80% of professional managers did not beat the market index over a 5-year period, rolling 5-year periods. I would say, why would I think I could pick it? Why would you think you could pick managers that are going to beat? Wouldn't you just want to go with the index and, 70, 80, 90% of the time you're going to win? And when you add on top of that, the cost and the tax factor with the index ETFs, the expenses, I was surprised that the active expense ratio was only 0.76 because I see so many funds that are well over 1%. But this core ETF, that's our Tarbox core ETFs, which is large, mid, and small, just the US core. It's 0.05 is the annual expense on those ETFs that we have. So big difference, and obviously over time that you saw how the difference in 1% or 2% compounded over time, huge difference in your actual return. And then taxes, maybe even more so. So actively managed funds, this is from Morningstar, the annual capital gains distribution is average 1.6% of your fund, which doesn't seem like a lot. It's always a surprise when you get that and you see it on your taxes, but that adds up over time. Whereas the exchange traded funds, 0 capital gains distributions. Now that doesn't mean that you don't ever pay taxes on your investment. If you sell your shares, you're going to pay taxes on whatever form, it's mutual funds or ETFs, but you get to control that. You get to wait to sell it until you want to. And if you keep delaying it and you never sell it and you never spend it and you hand it on to your kids, they're going to get a step up in cost basis. And some people do that. So big difference in taxes and expenses. It makes a difference over time. So we are believers in indexing and believers in exchange traded funds. And I've done it every which way from when I started out in my career. We used to trade stock options, kind of fast trading stuff, which was crazy. And, individual stocks, mutual funds, separate managers, all kinds of different ways. Learned a lot of lessons along the way. And we've been doing things pretty much this way since about 2001, 2002. So it works.
I get a question most of the time. What do you think of Fisher Investments? They're a marketing machine, and they're an active manager. And another financial advisor did a study on them and basically said that they did not beat the index funds over a 10-year period.
No. I mean, there's a lot of data. I know Mark Hebner has that. His website has some, because I had to use that, and I used some of his stuff on that. It's pretty crazy. No, they have not done that well. It's a total marketing machine. And he's a weird guy. I talked to him for a while at a conference last year because he was hanging out by himself. Nobody would talk to him.
Yeah. Well, we're not going to go to it in personal life.
Ken Fisher and I are on the same page on annuities, but their performance isn't great. I mean, it is a marketing machine. I mean, the thing is crazy. It's just wouldn't recommend it.
Yeah, I think for the average consumer, because you don't talk to your neighbors about your money and how you're investing, hey, what are you doing? And, chit-chatting about money. People just don't talk about it. And so whoever spends the most money and gets their name out there seems to be the person who gets the business.
Yes, definitely. Or the nicest person. There's always that, right?
The friend that you met at church.
Yeah. I mean, you need to have, your advisor needs to be nice and needs to care about you and your situation, but that shouldn't be the
better know what they're doing. Use the ask first.
And I care about the fact that we have 30 minutes to go.
Okay.
Good.
So we kind of talked about the expenses. Just to trade stocks, when I started out in the business, brokerage firms would compete, and you could pay like $250 to buy 100 shares. I mean, that was standard, 100 shares of stock. Now it's zero at some places, 5, 10, 25 bucks. It's same with ETFs, really inexpensive. So that's really not a concern because you shouldn't be trading a lot anyway. The ongoing expenses on the mutual funds and the ongoing expenses to an advisor, that's what you should focus on, whether that makes sense. So sources of research, again, Morningstar is where I would start on the mutual funds. These are other ones. We use Bloomberg and Morningstar a lot, all these services. I want to be sure we get lots of time on asset allocation here. So most important is to have a strategy, and that it's probably true with most things in life if you think about it. And it's amazing how many advisors don't really have a strategy. They're just, hey, this is a good stock this week, or hey, this fund my firm just, is recommending. And, you kind of put together this portfolio there's not really a strategy there. But what is it? Are you going to take an asset allocation approach, or are you going to be, a Warren Buffett devotee and say, I'm only buying value stocks and stick with that style? Many of those can work if it's a strategy like value investing, but you will likely abandon it at the worst possible time. And that I've seen that happen many times where, you had a strategy and, it wasn't working. And that's when you got out, which of course was about the time that strategy came back in favor. I'll kind of tell you how we got to our strategy, but have a strategy, stick with it, diversify across asset classes. Don't just buy all large company stocks, buy small ones, buy international, and of course, bonds and fixed income. And in addition to the stocks, which we'll talk about, watch the expenses and taxes, and don't try to time the market. I mean, it's like, do I need to even say anything given what's happened the last 3 months? Who could imagine? I mean, we've got to be like flat on the S&P today, year to date almost, after the market today.
Up 829 points on the Dow. It's at 27,110.
Yeah,
it got as low. What is it? 2,200? We're 2,300.
I don't know. I just noted the Dow.
Yeah, those were not fun weeks, but and our job during those weeks was to say, yeah, it looks really bad, and the world could be ending, but you know what? It's like it is helpful. I've been around doing this a while. In 1987, Black Monday, the biggest one-day drop, living through that, living through the tech wreck market in 2000, 2001, and then the last recession. You can't figure it out. The market is not really rational. You can't predict what it's going to do. And we were talking internally here about how part of why the market is doing well, we think, is that most of the investors in the market were probably around for the Great Recession, and they learned how wrong it was to have cashed out and how things could turn around more quickly than they think. That may not be true this time, but I think that's part of it, is people are hanging in there. I mean, it's been much easier not easy, but easier to get people to hang in there. I mean, the few weeks it was really bad, and there were so many unknowns, and there's still so much uncertainty. It seems like people are feeling pretty overconfident, but we could have a quick recovery. Who knows? And don't try to guess it. Think long term. So this is my thing where I'll show this to prospective clients, and I'll say, we have no idea what's going to happen in the market in any year. It's like, all I know is long term, that's going to be the place to make money if I can do it in a smart way, tax efficient, cheaply. So this on the top row is the top performing asset class in all those years, and the bottom is the lowest. And I always think of 95 through 98 when it was Microsoft, Cisco, and Intel. And literally, we have a database that we enter all our notes in, and you go back to the peak of that market, and the little old ladies were mortgaging their house to buy Microsoft, and it was, everybody was doing it. It was just crazy. And we talk about this large value focused manager locally that went out of business because they lost investors. I actually lost a client in a defined benefit plan that we had a 14.5% annual return for 3 or 4 years, and why should I pay you to get that? That's nothing. People wanted, 33% return or whatever. And of course, that we know how the tech thing ended. That didn't end well. But the thing is, you think it's different this time, it's going to change, but there are cycles. And the point of this chart is it's pretty random. And the difference between the top and the bottom is very big here. You look at the emerging markets and 55%, 26%, 34, 32. I'm like, why? Why wouldn't I want to be doing that? We got 5 years running and then down 53%. And you can bet most individual investors got into emerging markets right at the peak probably and really had a hit. If you had a diversified portfolio in that downturn, you were down maybe 18 to 20%, in diversified stocks for a very short period of time. So I love this, the periodic table of investment. So, we don't know what's going to be next.
Yeah. If anybody tries to predict, show them this chart.
Right. And this one too. I mean, this is how it goes. And, advisors who've been in the business for a long time. I mean, when you have a lot of clients, it's just, the mood, you can just track it. And I was really excited when we were in the worst of this at some point, because everybody was people were kind of crazy pessimistic. And we're like, oh, this is a good sign. We're almost through the worst of it. And sure enough, it's like you're individuals are just you're going to talk about that next week, I guess, Pete, but it's just crazy, the psychology behind it. And professional advisors are prone to that too. And especially if you're on the phone with clients and everybody's so negative and telling you all the reasons everything's going to be so bad, you could succumb to that, which is why I like having a team or a study group of other professionals to kind of check, my thinking here. But, we make sure that people are in the right portfolios, which we'll talk about next in a second. I just want to point to this chart, which is a different representation of the chart, saying how often you have a period of gain, a period of loss at every 1 in 4 years on average. You have a down market, but over 15-year time period, no loss of principal.
So one of the things that we always talk about some of the advantages of having a professional advisor, and most people think when they hire a professional advisor, it's all about investment return. And I look at it as, especially if one of the spouses who was handling the money dies, and now the person who hasn't handled the money at all doesn't know really what to do, who to talk to, and a financial advisor, a good financial advisor, would help them prevent from doing something really dumb and losing all of their assets.
Yeah, and it's hard to tell people that, of course, because you don't want to think that's you. But you actually, some of our biggest, more sophisticated clients, we have a lot of people who are in the financial industry, retired hedge fund, venture capital people. And, they are sometimes wanting to do really stupid things.
Yeah.
It's, you just gotta talk yourself down. Or if you can afford to set aside a play account to take some of those flyers, to buy that stock where your kid's company that's going to be the hot thing. I mean, it's okay to do some of that, but as far as your core, what you need to live on, your retirement portfolio, you need to be really prudent with it. This chart shows if you missed, the best days, and that's what happens. People get, the timing, and I have that kind of chart too. It's like you'll miss all the returns of the market. You're not going to get that 10 to 12% if you can't ride out the tough times, because you're not going to call it right.
And Laura, every time we've shown that chart, because it's been in a couple times, people always ask the same question. Okay, I missed the high day. What if you always miss the low day?
I feel like we've done a lot of that analysis. Well, that would probably be good if you could.
Right. So that's the argument is, well, wait a minute, isn't this, which way are you looking at it? So,
yeah, right,
yes.
right.
Okay.
So this is basically a central tenet of what modern portfolio theory basically says. How you split your pie between stocks and bonds and everything else is going to be the biggest determinant of your investment return. So, 94%-ish of your return is going to be because you're in stocks and bonds, not because you had, Bank of America versus Microsoft over time. It's like the big picture is what asset allocation is about. It doesn't mean having 5 mutual funds that may be overlapping in the same type of funds. You've got to be sure you're in those different asset classes like that were on the periodic table. All, maybe not those specific ones, but you need to be in different asset classes that are going to do well at different times. It doesn't mean you're not going to have a loss in any short-term period of time. You never have a loss until you sell. So, as long as you don't sell into a down market, which this is what I really think a lot of investors have learned, at least a lot of our clients have learned. And if you are buying individual stock, there's a lot of studies that say you don't need to have more than 20 stocks to get diversification. More than 50 is definitely more than you need. If you're buying the index, if you're buying the S&P 500 index, you're going to have 500 individual stocks. You're not going to see it in your fund, but you actually have a lot of companies.
Laura, when you say research shows, we're talking about research done by PhDs over a period of time. The modern portfolio theory is not something that was made up by Merrill Lynch.
Right. Yeah, it's academic. Largely
it's academic. It's
yep.
research based. It's evidence based.
It's evidence based. Yep. Yeah,
And
that's what real advisors study. At brokerage firm, you take sales classes.
Yes.
Just saying.
Yeah.
So this is probably the most important thing: is how you slice your pie. Is going to be the most important determinant of your success. And this is very basic, but just kind of, these are fairly standard definitions. These actually fit fairly close with ours, though we have alternatives and some other things thrown in. But this also ties into like Vanguard. So we also like Vanguard, and we're saying if you want to do it yourself and make it easy, go buy the Vanguard growth portfolio or the Vanguard moderate growth fund. It's a blend of a lot of their different ETFs or funds index funds that are across the different asset classes. So you get all the diversification. They're rebalancing for you. It's tax efficient. It's cheap. It's a pretty good way to go.
Yeah, investing does not have to be complex.
Right.
People think that investing is the easiest part of the financial advisory business, I think.
Right. And the more you do, the worse it's going to be. The more you trade, the more you try to change things around, the worse it's going to be. I mean, buy one of these portfolios and hold it. What you do if you're doing this on your own and building these portfolios in a period like we've been through, it was a great opportunity to rebalance, which means you're selling the thing that went up and you're buying the thing that went down. So we were able to buy into things as they went down, which is not what you feel like doing, but that's what rebalancing is.
What does the dark color mean on the chart?
The dark color is stocks and the purple is bonds. There's a little key at the bottom, but
okay.
Yeah. So growth, typically it's a common growth split would be 80% in stocks and 20% in bonds.
And does that mean that the 80% that you like, say, for instance, the growth, does that mean it's in one asset class?
No. So this next slide, this is a demonstration of what a moderate growth portfolio might look like. And the moderate is the 60% in stocks, 40% in bonds. So, we believe in most of the stock should be in large cap. It represents the biggest share of the market cap. Large cap have done well over time. Small cap is riskier in the short term.
What are you going to go through? I would love for you to go through the entire chart and kind of explain it.
Yeah. So large cap stocks, we buy the IVV, which is the ETF index. In mid cap, we buy the mid cap ETF. That's the mid-sized companies. And small cap, there's a lot of different indices. There's 2 main ones. We actually switched from the Russell 2000 is a common one to the S&P 600 because it's the larger small cap stocks, and over a lot of cycles that had done a little better. We made that change a couple years ago, I guess. But there's ways you could do that. International stocks, the index for international stocks is called EAFA, EAFA, Europe, Asia, Far East. Thank you. Thanks, Mary. Yes. So it's the larger international companies. We also like to have a little bit in emerging markets. Obviously a higher risk, but higher return over time, as you saw on that chart. So emerging markets are, more undeveloped markets, the Brazils and those kind of countries, China. And then there's also frontier markets, which we may put in a higher risk portfolio that are even, smaller companies, Costa Rica, Estonia, so on. Core bonds would be kind of the core bond index. There's
Corporate bond portfolio.
it'd be corporate if it was a IRA account. It would probably be munis if it was a taxable account. And then EMFM, that's emerging markets or frontier market bonds. And we actually aren't buying frontier markets on the stock side, but we are buying them on the bond side. We feel like that's a safer way to get exposure to that market. And then global bonds, same as global stocks, would be a fund that has both U.S. and international bonds. And then short-term bonds, and we might do different things. We move around a little more on the bonds here. We might do a floating rate or different kinds of bonds there. But this is a breakdown of all the different kinds of bonds in that 40%. So this is just, this is an example. I think
On the bond side, Laura, what's your duration or maximum duration that you have today?
6 or 7. Yeah, 6 or 7 years.
Okay.
Yeah. Again, that it's not just in, and if you buy the Vanguard funds, they're doing this for you in those Vanguard funds. They're picking them and they're rebalancing and all that. I want to mention alternatives. I didn't show alternatives in that chart. We do have some allocation usually to alternatives. You could argue that it doesn't make sense. That it hasn't helped a lot.
What does alternative mean?
Alternative is anything that's not a stock or bond. I mean, we think the definition should be anything that's not a stock or bond that's uncorrelated with those markets so that it moves differently. So it's not going to be affected by what's going on in the markets. So that's the ideal. It's hard to find an investment that's truly uncorrelated with the stock and bond market. As a matter of fact, we've got some holes because we're looking at some funds right now. In the past we've owned reinsurance, that's what Warren Buffett invests in. That's completely unrelated to stock and bond markets. It's related to all the other bad stuff going on in the world and can be a riskier asset class. Real estate could be considered an alternative, venture capital, private equity, arguable if that's going to move like the stock market. You might not put that in that category. Hard assets, gold would be an alternative. We don't believe in gold as an investment. Again, that's kind of gambling. Long term, it hasn't performed when it's supposed to and has underperformed other asset class pretty significantly.
Laura, hang on a minute. There was a question of, since you mentioned Warren Buffett, it happens to be a question. Warren Buffett hasn't been real keen on bonds. Why should we buy them if he doesn't?
Because most people can't take the amount of volatility that he can. And if you want to smooth out the bumps, you should own bonds.
Well, and he buys and holds.
Yeah.
As you said, you don't have a loss until you sell.
It's his companies, his investments. Yeah.
Right. Yeah.
I don't invest in bonds. Which like my firm hates when I say that. I'm like, actually, my compliance officer is sitting over there. She's probably, you should say that. But long term, you're going to do better in stocks. And it's a very tricky time for bonds and fixed income right now when interest rates are zero. Because in bonds you make money. When I first started my career, many of you have heard the story. I had a money market fund yielding 18.2% with check writing. So when interest rates go from 18 to zero, that 35-year period, whatever, you made a ton of money in bonds. When interest rates are at zero and, when they go up, that's when you're challenged and could lose money if you don't hold the bond positions. But it's there as a ballast. It's there. And actually what it's really there for with our clients, we make sure that they have enough spending, usually at least 6 to 8 years of spending in bonds and fixed income. So that's how we help decide how to split that pie. Someone like me who's saying, I want to be all in stocks. For my clients, I would say, no, you're living on your portfolio. We need to have a certain amount in bonds and cash so you know that you could draw all the cash and bonds and not have to sell stocks into a long-term downturn.
Yeah, and I think that's the difference, Laura. You're not living off your portfolio.
Right.
You're still.
Yes, you can be aggressive when you're still adding and you're not living.
Yeah, you have other income, etc. So. Right. But
yeah,
if you're
no, I am
90
not recommending that. I really shouldn't
Yeah.
even say that.
Yeah.
But
yeah. Let's say
Um,
what just recently the stock market had gone down how much percentage wise? The S&P 500 20+%.
it was over 30.
Yeah.
Yeah.
So you kind of ask yourself, you know, how much of a loss did you lose sleep over your portfolio when the market went down that high? And if you lost sleep, then you need to move more into the bond area.
Right. And, you know, we actually, when we had the last downturn, we had kind of a list of clients that we were worried about because they had a tough time with it. And we did get them to hang in there. But once the market recovered, we went back to them and said, you know, do you want to step down in risk so that next time this happens, it's better? Most of them didn't. And actually, then we had the opposite of people who did get conservative. We had a few who got conservative. And then they said, you know, I want to get more aggressive, but the market kept going up. When's the time? So we had, I think, 4 or 5 people that we called, like when the market was down 25%, we said, well, now would be the time to go more aggressive. And I don't think anybody did.
No.
Everybody stayed the course and one step down a notch.
Yeah.
But, you know, it's like, that's fine to make those tweaks. Selling your whole portfolio is when you get hurt. And so this is, you know, stop watching the news when it's hard. So, I mean, especially when you're quarantined, it's really hard. Between the virus, the market, and, you know, everything right now. So yeah, and then rebalancing, which is buying the thing that went down and selling the thing that went up. And it's really hard when something's going up. And, you know, how often you rebalance is, you know, it's debatable what makes sense there. A lot of different studies on that. Do you do it monthly, quarterly, annually? There's not that much difference between doing it monthly or quarterly and annually. So usually for most people, you know, every year just rebalancing so that you're in that, you know, whatever pie you have, the 60-40. So you rebalance to the pie. We're doing that ongoing.
But the important thing is to have a strategy to, you know, what is your portfolio? 60-40. Okay, it's out of whack. Let's get back into it. That means we're going to sell some of our winners. Right.
And you know, the thing that's tricky and where, you know, an advisor can help, you know, we're not picking stocks, but we add a ton of value. So when we're wanting to rebalance people, we have to make sure that we're not going to incur any short-term capital gains. We want to look at the tax situation to make sure we're able to balance some of that and, you know, take some losses, take some gains and offset. All that's important. And I think that's something that an advisor can certainly help with. And then to let you know how you're doing, it's
very difficult if you're a layperson or even somebody, if you don't have the software tools to try to figure out what your performance is.
It is. And like we have clients who will go to the brokerage account and they see certain things, but that's not a measurement of your performance. And It's not that easy. And it's not always that intuitive, especially if you're drawing from the portfolio. So that's what we're telling people. They'll say, well, you said the account's up, but my account's down. It's like, yeah, because you took out $5,000 a month the last, you know, it's like you have to consider your deposits and withdrawals. And it takes, you know, sophisticated software to do that accurately, which advisors, you know, most good advisors have that. And there are different ways to measure that. And just, I wanted a couple comments. There's time weighted and dollar weighted. And time weighted, it basically does not take into account the cash flows, the effect of cash flows. And that's how you're supposed to compare managers, because you shouldn't favor a manager who did better just because you deposited the $100,000 into that account the day before it went up. That's not that manager's call. So that's how time weighted works. Dollar weighted is what actually happened. It's also the internal rate of return. It's the same term. The same thing where it is actually your real return, because your portfolio will be affected by when you put money in and when you pulled money out. And so that is the real return. Some advisors show both of those, but they're supposed to show the time weighted at least. And I think none is probably the most popular method that you don't even really see that. And then just the whole thing about benchmarking, you know, you need to know how you're doing but how do you know if you're doing okay? And that's what we've had clients say, I just want to know that I'm getting what I should be getting. How do I know if I'm doing okay? And it's not that straightforward, because you shouldn't be comparing yourself to the S&P 500 index. I mean, maybe I should if I'm all in stocks, but even so, my portfolio is very diversified and international, and that wouldn't be the right index. So you have to have an index that is relative to what you're doing. And if we look at those Vanguard's funds. If we're doing a 60-40 portfolio, maybe that's a good measure to how we're doing. The way we do it, we're buying the benchmark. We are the benchmark, and part of our value is the benchmark that we've created, the actual percentages in those different categories. We chose that based on a lot of different things, and we're going to just buy those. We're going to buy the index. So we're not going to underperform it or outperform it. That's not what we're trying to do. We're trying to get the index. So people play tons of games with benchmarks. You can show me a benchmark and I can beat it. You can play any game with benchmarks, and you can pick benchmarks that make you look better.
Laura?
It kind of depends how you do that.
Laura, do you buy specific Vanguard funds? The question is, could you name any of the Vanguard funds you use?
No.
I've used the All Stock Market Index Fund.
Yeah, so it's Vanguard Strategic Life. Yeah, the ones I recommend are the Vanguard Life Strategy Growth and Life Strategy Moderate. I mean, I think it's the same names, conservative, moderate, and growth, but it's the Vanguard Life Strategy funds where you're getting all of their funds, they're rebalancing for you. We use those sometimes in smaller accounts. We do use those, yeah. And Vanguard's good, except they're really overwhelmed, and their service might not be great right now, but their products are pretty good.
I was on the phone with them for an hour before I got to a representative. They're not busy.
Yeah. And there's a talent shortage in our industry, so a lot of those people are not going to be very experienced or well trained either. So picking, your philosophy, are you going to index or use active managers? I'd say no to market timing. The right mix is different for everybody, your stage in life, whether you're especially risk averse or not, and, doing it yourself or hiring a professional. And this slide, this is from JP Morgan. I think Vanguard had originally created this slide, as a matter of fact, but now JP Morgan puts this out. And this shows how that, like the 60-40, this is kind of our version of the 60-40 moderate portfolio at Tarbox, how that has performed over the last 19 years, 20 years, last 20 years, versus the S&P 500. So this is where it's saying the S&P 500, a little over 6%, but you don't want, an all stock portfolio. So if you had a moderate portfolio, you're a little less than that, and then bonds lower than that. And then EFA is the international index. And then homes, real estate, different in different areas for sure. Everybody thinks real estate goes up because you don't see the prices going up and down, and also because you're usually using leverage when you have your home, which can make those returns go up on real estate. But that's always interesting too. People think that real estate did better than the stock market long term, and that's not been true over any time period. And then inflation, 2.2%. But the average investor's return that didn't even keep up with inflation. While the S&P was up 6% a year over the last 20 years, the average investor got less than 2% because they timed the market and they got out when they were afraid and they didn't buy in at the right time, and they tried to figure it out, or they were picking the wrong funds or the wrong managers. So this is a really nice argument for why you might want to work with an advisor. What do you get with an advisor? Some advisors just do the investment management, and that's great. Some of them do a good job at that. But most advisors, certainly most certified financial planners, I would say, do a lot of other things: financial planning, wealth management. They're really looking at your overall situation and how your portfolio fits in with you. It's not just one fits all. And the hand-holding and protecting yourself, protecting you from yourself and protecting you from others. We do a lot of gatekeeping of people who are trying to sell, reverse mortgages or whatever.
Protecting you from other family members.
Yes, that too. We've had family interventions of the kids who were spending down all of the parents' money, mom usually. Yes, yep. A lot of times we do those kind of meetings. I think that's pretty common.
For less than 1% per year.
Yes,
it's
such
just
a
bargain.
Such a deal.
Yeah.
And and very transparent and disclose that fee also. And we don't for people who do it this way, and all the presenters in the It's Your Money sessions are, vetted fee-only planners. And I know people have tried to sneak in and say they are, and, Pete will catch them. So, that is so important in itself, is working with the right kind of advisor. And, even if they don't do the best job at a lot of this, you're going to be so much farther ahead because you've got somebody who's on your side of the table.
Since we're almost out of time, go forward one so that they have your contact. No. Forward. I want your cut there.
Yes.
Contact information so they can call you.
Yes.
Call, email, do whatever. We need to get the
Probably
word
not
out.
by yet, but we are at the office. So.
Yeah, well, it's so important to spread the word on the fee-only fiduciary advisors in the community, because they're the ones that have your best interests at heart, and brokerage industry has the money.
Yep.
Laura, do you want to stop sharing?
Yep.
The red thing at the top. Thank you. Okay, it is 3:00. It's 5:00 somewhere. So as we always do, thank you very much. Appreciate it. And we have one more week next week, and we will see you then. Thank you.